welcome one and all to our third Business Basics webinar. Thank you for joining us. If you are just joining us today for the first time, a warm welcome to you. And for those of you who've been with us from the beginning, from last week and the week before, thank you again for joining us, and welcome to you once more. This webinar is made possible by the Big Up Small Business Project, which aims to create new opportunities for small, micro, and medium entrepreneurs in Jamaica to benefit from tourism. And the Big Up Small Business Project is a joint initiative of TUI Care Foundation and the Travel Foundation. So before I go any further, I'm just going to ask that if you want to, as we did last week, you can, the chat is open. So feel free to introduce yourselves in the chat. You can introduce yourselves to everyone while we are going on. I'm Coral Williams, and I'm the Jamaica Program Coordinator for the Travel Foundation. So hosting the session with me today as well is Rebecca Armstrong, and Rebecca is the Sustainable Tourism Specialist at the Travel Foundation, based in our UK office in Bristol, and I'm based right here in Jamaica. And together we are responsible for implementing the activities under the Big Up Small Business Project. So as I mentioned in the previous sessions last week and the week before, the Big Up the Business Basics webinar series is part of our capacity building support under the project. And this is being brought to you by the Travel Foundation in partnership with TPDCO. We began the training sessions 2 weeks ago on the 6th of October, and we're going to continue them until the 3rd of November. So we hope that so far, those of you who have been joining us and who have been journeying with us, we hope that so far you have been finding the sessions useful and informative. And we also hope that if you have not already started, that you'll be able to put what you are learning into practice to enable you to grow your tourism businesses. So each week we focus on a different topic in the series of webinars. And today's topic is going to be on preparing to access funding. This session is really designed to help you to understand the different types of business operations, help you to learn about the different types of funding and financing that are available to small businesses, and also help you to be confident in assessing your business's financial needs and know how to approach funding agencies. So there's quite a bit packed into today, but we also want you to know that we'll be sharing with you at the end a manual and the slides from this presentation. So don't worry if you miss something. Next week, Thursday on the 27th, the training is going to be focusing on future-proofing your business to make it sustainable. The final webinar is going to be on Thursday, the 3rd of November, and that one will be on digital marketing. You'll be able to get tips on how to promote your tourism business and how to maximize your marketing. So make sure you do register for those upcoming webinars. My colleague Rebecca is now going to take us through introducing the presenter for today's session.
Thank you, Coral. Yes, we're delighted to have Dimitri Dawkins from Graft Ventures with us today. Dimitri is very knowledgeable and practical in terms of accessing finance for businesses and taking you through the process of understanding your business's needs and the different sources of funding available. He's previously worked with the Brunson Centre of Entrepreneurship and founded Graft Ventures to be able to match entrepreneurs with capital and manage. Just a couple of housekeeping notes just before I hand over to Dimitri. Please do use the chat to use yourselves and your businesses to each other and to us. That would be great, and to just put any general sort of queries or comments in there. But please do also use the Q&A box, the question and answer box specifically for any questions that you'd like to put to Dimitri on his presentation. Do that as he goes through. If anything comes to mind, we'll be monitoring the chat, and then at various points Dimitri can pause to take those questions. So please do make use of the opportunity to put any questions that you'd like to Dimitri. So yeah, I'm delighted to hand over to you now. Dimitri, please do share your screen once Coral's taken the slide down. Thank you.
Thanks, Rebecca, and good morning, everybody. Let me just set up the screen. Right, so morning again, everybody. I'm really happy to be here this morning. I know that finance is something that everybody always wants to talk about, and I have a particular passion to get people funded and make sure that they can access funding. Overall, it's really been a pleasure working with the Travel Foundation on creating this content. I know that after this session, you guys will get access to our brand new guide on how it is you can prepare to access funding. And so the session today is really to go through it's how best to leverage the guide. We're going to go through some of the content points in the guide as well, and better get you prepared before using the guide as a manual. For our rules for this session, number one, I'm going to ask you not to do any multitasking. Frankly, guys, if you're distracted, you're not going to understand. You're then going to say, oh, I'm going to watch the recording afterwards. In truth and in fact, you're probably not going to watch the recording. So let's just be honest with ourselves and set aside at least an hour to just focus on the task at hand. Most everything you can get back to afterwards, but if you don't pay attention in this initial session, it is unlikely that you'll come back to it. Please use the Q&A panel to ask questions about different topics. Don't wait until the end. We have Maria online as well. She'll be monitoring the Q&A. So if you ask a question, then Maria will just stop me and just say, hey, Dimitri, we have a question. Can you get into more detail about this? I want us to maximize the time here this morning. And so if you have any queries, any concerns, if you need me to go into more details, if you want me to give you some more examples, then just ask in the Q&A and I will get to it in short order. But once again, make sure that it is practical and applicable to you, and don't just sit there and wonder about this and say you're going to research later. Again, not saying you won't, but it is highly unlikely that you will. And then the last thing is to just take notes. If you hear a very valid point or something that you want to make note of later on, just write down the notes same time. If you don't have a pen and paper beside you, then feel free to take a note in your phone and your note-taking app. If you're on your laptop or on your desktop machine, just open the notes app and just record it at the same time, or even just send yourself an email or something else. Whatever works easiest for you, but make sure you take notes so that way you can remember later on. All right, so what we're going to get through today is to overcome some mental blocks about financing. Access to finance is usually an overwhelming point. It is something that very few people understand. It's almost like a dark, mystical art, right? But the fact of the matter is that a lot of that mysticism is actually in our own heads. And I want to make sure that we just bring everything to a level so that way we have all an equal opportunity to learn, to understand, and to apply for funding as needed. We're going to go into what's required to prepare for financing, and we're going to go over some of the common types of financing. Now, just a reminder, we'll be sharing a guide with you after this. It's a very detailed, in-depth guide, step-by-step on how to prepare for financing. So this session is not to just, you won't be able to leave the session and just go to your bank and apply for a loan, but we're just giving a high-level overview so that way you can leverage our guide fully and then access funding in the future. So first off, I want to start off, we're going to have strong views, but loosely held. This is very much a learning process. So start off with, hey, you might have some understanding already. You may have some existing biases, but just be prepared to let them go. Things change over time. A lot of processes have changed since COVID. There are changes on a day-to-day basis. And so don't just stick hard and firm to what you know already, but understand that, hey, there are some tips and tricks to be learned here, and be willing to be open and accept them. So let me just run through the philosophy of financing here. And this is, the first one is a real pain overall, but really and truly it's easiest to attract funding or financing when you don't need it. And I think this is what creates the most frustration with people, right? something has happened in your business, you need to access funding, and the bank tells you no, or an investor tells you no, or somebody offering grants tells you no. And unfortunately, many of the factors that go into decisioning for financing, no matter the financing type, rely on success. And so inherently, successful businesses tend to attract funding easier than those that are not as successful, right? So when times are good, that's especially the time to seek external financing, and not just at times when you need it, right? The next point is that, you're in the business of making money. Financiers are in the business of protecting money. Most people who offer financing have received money from a third party or external party. And genuinely, the business model that they use, whether they're lending money, whether that they're doing an equity investment, even as a grant, the business model is based on generating more value and generating more impact. And oftentimes, if the funds don't generate that value and impact, then it is worse off than just keeping the money in their account in the first place. So we need you to focus on your value proposition, what's this that you do on a day-to-day basis. And the business of financing itself is actually to protect money, to create value in the process, but they're protecting money first because of the risks associated with their business model. The third thing is that simplicity is best. The easier the business is to understand, the easier it is to understand the benefits. And the fourth thing is that you're the expert, right? All transactions are based on trust, and you need to demonstrate why you should be trusted. I think that too many times operators in businesses, founders, entrepreneurs, etc., whatever category you fall into, you discredit yourself when speaking to a financier. We might say casual things like, "Oh, I'm not an expert on this, but this is what we're doing, ABC." No, a financier is trusting you to be the expert. You have been running your business for whether it be 3 months, 10 years, longer. You know what it is that you're doing, and you're coming from as a subject matter expert to a financier who is not a subject matter expert in your industry to say, this is what we do, this is why we excel, and this is why you need to trust us with your money, right? So don't discredit yourself along the way. Don't just diminish all it is that you've achieved. Make sure that you focus on the value that you provide and share your track record, including the bad, right? Nobody's perfect. No institution has never had a hiccup. No team has never had a failure. So you can say, last year, the last 2 years, things were rough because of the pandemic. This is how we pivoted. These are the issues that we found. This is how we overcame them. We're still having certain issues and we haven't overcome yet, but we think that we can by implementing these processes, and this is why we need financing. Building trust includes the good and the bad, and demonstrating that you understand your business just demonstrates your expertise, and once again, contributes to building trust in the process. Whoops. I was way too far ahead there. So, right, guys. Let's just identify some key steps to success in this financing process. When you get the guide later, number one, you want to read each section. You want to complete the activities in each section, paying special attention to the pro tips, your circle, light bulb icon, and some pro tips. These are things that will help you move along faster and make sure that your documentation is comprehensive, and make sure that you complete everything in the section before you proceed to the next section. And why this is because, as I mentioned before, it can be a complicated process, especially if you're not familiar with the process. And we want to break things down into bite-sized chunks. There's the old saying, Rome wasn't built in a day. And in the same way that you won't get through your financing prep in one single day. Take it step by step at a time, because if you take on everything at once, you'll be easily overwhelmed. And once you get overwhelmed, it's very hard to get back into the process. complete a section, take that quick win, review what you've learned, review what you've documented, and then move on to the next one. Bite-sized, manageable pieces. And this is something to apply to for all of your projects that you're doing, all of the different activities. But by taking small steps, then you'll eventually get there. The target outcomes that we have for both this session as well as the guide itself are, understanding your cash flow, categorizing your use of funds, understanding the total value of the financing that you need, understanding the different types of financing that you need, understanding when you're going to need financing, analyzing how your finance payments will be managed, making sure you have a business plan, and to have financial projections. Now, it's impossible for us to cover all of this in 1 hour, but if you follow the guide in a step-by-step manner, you'll be able to get all of this done in short order. Some people will be a little more prepared, and maybe it will take you a couple of days, some people a little less, and maybe it might take you a month. Once again, take things step by step and move forward. The other thing is managing your time. So when you're using the guide, just like how you're dedicating an hour of your time this morning, dedicate at least an hour to the guide at a time. Put your phone on do not disturb, ignore the other calls, don't check your email, don't check your social media, whatever other notifications, close the door if you have a busy work environment, etc. Try to minimize all of your external distractions as much as possible. Guys, some people are really, really good at multitasking, but for deep, intense work, oftentimes you can't do that. I'm not saying don't play any music in your background or stuff like that, but if you're not a finance expert, it's going to be very hard for you to jump into the guide, jump back out, deal with a pressing matter, jump back in, etc., etc. It's not going to work. Try to book out 1 slot per day. It could be maybe early in the morning before you start your day-to-day activities. Maybe it's late at night. Maybe it's just 1 hour during the day that you just siloed yourself from everything else. You're not going to have all the information. And if you don't have all the information, contact the stakeholders who do and provide a deadline. So you're going to need help. You may need help from your accountant. You may need help from your operations manager. You may need help from another coworker or another team member. Ask them for help and say, hey guys, can you help me with this? I need this information. And can we discuss it before? Can I get this information by Friday? Can I get it by next week, etc.? If you don't provide a deadline when asking for help, then people will forget. It will just go on rolling over and over and over, and you don't get things done in a timely manner. So make sure that you have a deadline or timeline when asking for help from your peers. And the last thing you may need to do is research. You may need to look up other examples or explanations online. We have tried to be as comprehensive as possible in the guide or even in this session, but not everything is going to click the first time. And sometimes, there are other materials available that can better explain it, that will be more relatable to you. So be prepared to do some research as well. In your 1 hour, maybe you want to break things down, do an initial reading, write down stuff that you want to look up some more, write down some points that you need to ask others for data for, and then just plan out what you're going to do for your next session afterwards. So for the guide itself, it is generally a guide. We try, once again, we try to make it as comprehensive as possible, but there will be some variances. Pay attention to the requirements from financiers and adapt as necessary. Some financiers may ask for a little more details, some may ask for less, some may ask for things in different ways. When you review the requirements, what you can do is just, check it back against the information you do have and create a checklist of what you have versus not. In most instances, you'll want to seek professional advice from legal and accounting professionals to review agreements. Now, just like you're an expert in the tourism industry, right? You are not necessarily a lawyer and you're not necessarily an accountant. So work with other subject matter experts to help protect you. As a matter of fact, there's an old suggestion that when you first start a business, the first two people you should hire are a lawyer and accountant for that exact reason. Seek professional advice. The devil is in the details, and there's always fine print. And if you don't understand what that fine print is, you could be exposing yourself to a lot of risk. I know that legal and accounting help is expensive, but most times it's more cost effective than some hidden clause that you didn't understand that costs you a lot more money in the future. Make sure you understand all terms before signing an agreement, whether that be a financing agreement or otherwise, because once again, you could be accepting risks and liabilities that you don't understand or you're not prepared for. So get the professional help, make sure you understand what it is that you're doing, and have a backup plan. I mean, I know what it's like working in the industry, and oftentimes we have to have a plan A, B, C, D, E, sometimes as far as F or more. Have a backup plan. It's nothing is guaranteed to work. Operating a business is a difficult thing to do. And so you can have a plan A and a plan B. Maybe you might prepare a plan C as well, but just have alternatives. So that way, if things don't work out how you want it to work out, you don't panic, you don't worry as much. You just say, hey, it's okay. We knew that this might be a possibility, and we're moving on to plan B or plan C in that case. So let's talk about the preparation of the business itself. And once again, the guide is going to go into a lot more detail with this. But first thing in your business and accessing financing is to demonstrate sustainability. Unfortunately, there are a lot of bad actors out there who go out and create shell companies and seek financing opportunities with nefarious intentions to scam and defraud, etc. And so the first thing to build trust with a financier is to demonstrate that, hey, your business already exists, it's been operating in the industry, and this is how you plan to continue to operate and grow over the next few years. So you'll outline your financial strengths and opportunities. This could mean that, right now, maybe it is that you're already generating revenue. That's a financial strength. You may or may not be cash flow positive. That's a financial strength. A possible opportunity is that, hey, if we pay for some expansion, we'll have a new business line, maybe we'll reduce costs, et cetera, et cetera. These are opportunities of why opportunities that the business has if you get funding to expand. You also want to demonstrate a strong leadership team. What is a strong leadership team? It doesn't mean that everybody has an MBA or a fancy degree or 20 years of experience. You just have to demonstrate how it is that the team works together now, how it is that you overcome challenges, and the specific experience of that team. If the team has been working together for 3 years, that's a strong team because you have had relatively low turnover or no turnover in that time period. Or the fact that across the team, no matter the gaps, maybe you might have, customer experience, you have operations, you have finance, you have sales, you have marketing, etc. You have different team members to fill the gaps. You may still have gaps on your team. Maybe you have a critical team member that, or a critical role that has not been hired yet. But you can highlight that, hey, we realize we have a gap in our team structure. We want to fill that gap by hiring another person, and we would like to invest in this additional person to support our strengths or fulfill new opportunities that we have. So don't be afraid if there are gaps in your team structure. Highlight that there are gaps and how it is you plan to fill those roles, whether through full-time team members, part-time team members, or external service providers over the near future. And the last thing about sustainability is making sure you have good corporate governance or a strategy to implement governance. What I mean is most times financiers will ask if you have a board of directors a governance committee of different types. And so if you don't already have that in place, then you can also create a strategy that, hey, we would like to set up a board. You may even offer your financiers a role on the board as well, so that way they get oversight in the company. A governing board of directors is not an executive committee or an operating team. They are there to represent the company and the sustainability of the company, but they don't really deal with day-to-day operations, and they're not there to approve invoices, et cetera, et cetera. No, they're there to help support long-term strategic goals, plans, and monitor that execution. So to put things in perspective, a board is responsible for the continuity of the company, whereas the operating team is there to implement the activities that the company was created for execution. And guys, remember once again, if you have any questions, if I'm going too fast, anything, just drop it in the Q&A. Maria's monitoring, and she'll just stop me to ask those questions. All right. So there are a couple steps to assessing your financing needs. Before you can understand your full financing needs, you have to create a growth strategy. Oh, but Dimitri, we're running low on our payroll now every single month. We have creditors calling because we've gone over terms. We have to buy new equipment because our vehicles are out of date or costing us a lot of money for maintenance, or other key problems that you would want financing for. You don't want to access financing if you don't have a growth strategy. No matter the type of financing, there is some cost associated with it, even with grant financing. And I say that because it requires time and effort to prepare for that grant financing. And so that effort comes at a cost. So before you do anything, you have to create a growth strategy first. How are you going to grow this business over time? And the other pushback I always get is, not every business has to grow. Agreed, but genuinely, and follow my logic on this. If you have a business that remains as a plateau, you earn, let's just say, $1 million a month, and you continue to earn $1 million a month every single month for the next year, 2 years, 3 years. That business is actually declining because generally you have inflation to deal with. So the expenses related to operating that business typically increase month to month. Your staff costs, because they have to face inflation in their day-to-day life, will have to increase over time as well. And then even your customer base may change your spending because of inflation or because of other competing priorities. So you genuinely need to grow at a specific rate each year, even to break even, to just be sustainable. I think right now, depending on the market that you're operating in, inflation could be anywhere between 3 and 10%.
Dimitri,
sure.
Keon has a question. Should these board members be paid?
Okay, sure. Great question. Some board members
I'm gonna press the answer live option now. So I'm pressing it.
Okay, now. Sure. So yes, board members are often paid, not necessarily paid as salary, but paid as stipend per meeting. So depending on the agreement that you have with them for serving as a director, it will dictate how much they get paid. So typically there's a committee that will determine how much is being paid. Some board members are willing to serve for free. Some board members will not serve without being paid a stipend. And this could vary very much, so rates that I've seen for, say, Jamaica are ranged from zero. A lot of boards don't pay their board members a stipend per meeting. And I've seen it as high as, I think, 2,500 US per meeting. But there's a lot of wiggle room in between, and you should just have a conversation with those directors to ask if they're willing to serve for free or without a stipend, or what that a feasible stipend amount is. And remember, that should be matched back to their contribution to the overall business, that they're actually doing work, they're actually providing value to the business, and so they should be compensated. It's typically per meeting. So what will happen is that you normally have quarterly board meetings, so you'd have 4 meetings per year. And so it's very rare that all board members can meet all meetings each year. So you typically have a per meeting stipend, and that way they just handle a review and provide their inputs before each meeting. And if you have follow-up questions for that, just ask in the Q&A. All right, so yeah, so once again, if you don't have a growth strategy, and if your business is not growing per year, it is most likely declining and in the process of failing. So you start off with a growth strategy, because we need to make sure the business is sustainable, and sustainability inherently means growth. The next thing you do after creating a growth strategy is creating financial projections for 3 years. Now, if you're growing, you must grow by a certain amount. And so you should have an expectation of what you're going to grow by. A little known secret is just that really and truly, financial projections are all theoretical. You can test them. There are methods of creating projections, but genuinely, they're ultimately made up, right? Now, these are targets for you to hit, and you should be able to understand, based on your subject matter expertise in your business, what sort of growth is possible. You may know that you can't grow your business by 100% in a year, because 100% growth would require twice the amount of staff members, twice the amount of vehicles available, a stronger sales pipeline, a bunch of other things. But you may know now that, hey, when you run $1,000 in social media marketing, you typically have a conversion rate of, say, 5%. And so therefore, if you have an audience size of 100,000 people from social media marketing, and that leads to 5,000 sales, and you increase the social media marketing budget, then you may be able to build a stronger sales pipeline. That pipeline, when somebody say, for instance, in the tourism industry, that customer may book now, but they may not utilize the service for 6 months to a year, maybe shorter, maybe longer. What does that mean for actual sales? What does that mean for actual execution? When do you have to put things in place to prepare for that, et cetera, et cetera? So typically, I would suggest having more feasible, or try to make your projections as feasible as possible or manageable. If you know what it looks like, or if you know what's needed to grow the business by 10% per year, then aim for 10%. If you know what it's like to grow by 20% per year, then aim for 20%. But if you don't know what it's like to grow at 50% per year, don't put down 50% as your growth target, because you don't understand how to get there, and you wouldn't have outlined those steps in your growth strategy. So work with what you know, what you're comfortable with, what you think is feasible.
Question.
Yeah, Miriam.
From Claudette. If an organization is non-profit, how do we create growth in accessing financing needs? How do we create growth? How does one?
Okay, so a non-profit organization I don't think it differs from a for-profit organization. All businesses or organizations are there to create impact and value. So as a nonprofit organization, your target may not be that you're creating a certain amount of profit per year. However, you still should have a revenue target, whether that be through donations, whether that be through your existing sales or other revenue generating activities. And then your ultimate target would be that impact that you're trying to create. So for your growth strategy, you still want to target a certain amount of growth and impact. You will still have to target increases in revenue over time. And you will still have to understand the related expenses to improving that impact or generating that revenue as well. So there's really much of any difference with creating a growth strategy or financial projections for a nonprofit versus a for-profit organization. It is just a matter of, instead of necessarily, well, let me break this down a little further. I am of the firm belief that organizations should not focus on profit as a element of sustainability. I think that profit is there to support your mission, but ultimately the mission for your organization, no matter the type of organization, is what the organization exists for and what you're trying to achieve. So focus on the mission, focus on the impact of that, and then work backwards of what is needed to achieve that mission. If that means that you have to do some form of revenue generating activity to increase your revenue by 10%, 20%, 100%, whatever the ratio is, then you backwards integrate into, if it is that you ask for donations, then you might have to hire a fundraiser or more team members to drive donations, or maybe online campaigns or whatever channels that drive those donations. If it is that you create a product or a service as well, hear what? Those products and services have to be sold in order to increase your revenue for you to achieve your mission. So there isn't any much of a variance. Businesses exist for a reason. There's a mission, there's an intent, and then revenue, profit, anything else are all means to achieving that mission and goal. I hope that answers that clearly. And feel free to just ask in more detail if you want me to focus on additional details. Right. And that's actually a very good point to transition into calculating the cash flow trough. This is something that I find most business people never really think about. A company can be highly profitable. A company could be making tons and tons of money, and that doesn't mean that they have cash in the bank. If I sold you a product right now for $1 million US, I could put on my financials, my profit and loss statement that I made $1 million US this month. But if you as an individual can't pay me that $1 million, even though you've agreed, we have a legal contract, everything else, if that $1 million US does not come in, my business, I would have said, we made $1 million this month. We paid out 200,000 US in salaries. We have $800,000 in profit, and I have no money in the bank because we haven't been paid for it. That is a cash flow trough. And in the same way, when we're creating financial projections, when we're operating business on a day-to-day basis, we oftentimes have cash flow troughs. You may have a situation where, let's use an example that, say, month end is your busiest time of the month, right? Month end is also when a lot of people's major bills are due. You may have salaries due at the same time, et cetera, et cetera. If it is that you generate most of your business, let me just pull up my calendar here. And yes, this month end is a great example. You generate most of your business between the 28th, being the Friday, and the 31st, being the Monday, because that's one of your peak periods in the month, where you have the majority of your expenses being your team salaries that have to be paid out on Tuesday the 25th. You may be facing a cash flow trough where you have to pay out heavy expenses early on in the week, and your revenue is not going to catch up until the end of the month. In that case, you need to either have a buffer in your finances, you need to have X amount of money in your bank account for when that dips, and then towards the end of the month, it will come back up. right? So there are methods to calculate this cash flow trough, and the guide actually goes through that in quite some detail, and I'm going to discuss that very shortly as well. But the cash flow trough is the most significant tool in understanding your financing needs overall. If you can understand that one thing, you will always be able to understand when you're going to have financial trouble and be able to prepare for that ahead of time. And we would rather that you prepare for that ahead of time rather than it, sneak up and surprise you and you can't meet obligations to your vendors, or worse yet, cannot be prepared to provide the products and services that you offer to customers on a day-to-day basis, right? The next point is to identify capital expenditure contributing to the trough. You may not understand what capital expenditure is yet. I'm about to explain that. The other thing is operating expenditure contributing to the trough. We're about to explain that as well. All right, Maria, anything else before I move on?
No, everyone seems to be all good now, but we can just wait a couple seconds to see if anyone has any questions up to now, because we have quite a few people attending. Any questions?
All right. Oh, wow, we're up to 65.
Yeah.
Thanks, guys. I really appreciate you spending the time this morning. I'm really hoping you're getting some value from this. All right, so while we wait, here's one of the quotes that I really, really love. Revenue is vanity, profit is sanity, but cash is king. All of us would read business articles in the newspaper and hear about some companies making some what seem like unimaginable amounts of money in revenue, but that doesn't necessarily mean that the company is doing well. We've seen companies generate large amounts of revenue and still be unprofitable, which is what comes down to the profit is sanity, because somebody's like, well, we generate our profit for every service we offer, 20% of that is profit. And so this is, the business is sustainable. And yeah, sure, great. You can sleep well at night knowing that for every single product and service offered, you're making money on that. You're not making a loss on your products and services. But the last thing is that cash is king. If you haven't been paid for that profit or for that profit yet, or for that service, then that's going to leave you up at night. Say, you got some bookings for some tours through a travel agency or through a booking agent, and they collected the money from the customer. You have already provided the services, but the booking agent has not paid you your funds yet. You haven't been paid. You're out of cash, right? And so at all times, and especially since the pandemic, cash has proven to be king. Companies who have greater cash buffers oftentimes tend to do a lot better. If you have the cash to invest, or not even invest, but survive through cash flow troughs, then you have a higher chance of sustainability. And I think a lot of businesses have pivoted their operating models to make sure that they have, 3 months, 6 months, even up to a year of their business operating expenses in the bank, just in case of emergencies. So you don't have to separate with amazing team members, so that you don't have to downsize your operations, so that you can jump on opportunities when they pop up, like special deals from vendors, maybe even acquiring competitors as they fail due to not having enough cash. All right. And why cash is king is that, well, let's go through the cash flow, the cash conversion cycle. Once again, so this here, we have a couple of elements here. You have a customer here on the left side of the screen. On the right side of the screen, you have your vendors, your partners who provide you with the raw materials that you need. And inventory turnover, this is basically what your business is doing as an operation. This could still apply to services, where on the right-hand side, you have your team, you have still vendors, etc., and then you're providing a value to the customer on the other side. So let's once again run through that example of being a tour operator and working with a booking agent overall, right? As a tour operator preparing for a new tour, you would have purchased some things. Maybe it is just, some snacks, drinks, food, etc., etc. Maybe it is safety harnesses, maybe it is insurance, other utilities that you have to pay for, etc. Things that you need to have in place in order to operate. This is your business here. Things you need to operate. Your business provides goods or services to a customer. That customer may have paid you directly, and so the money comes back to you, or they may have gone through an agent and you have to wait for this money to come back to you directly. You then over time pay for the goods and services, and the cycle goes around and around and around, right? This is the cash conversion cycle. What you've invested in preparing for delivery of your products or services that you have available as capacity within your organization in the middle, your actual provision of the goods and services, getting paid for that, and then paying the money back out to vendors, partners, team members, etc. going forward. Hope that's clear to everybody. This is a relatively simple concept that can get very complicated depending on how long it takes you to get the goods and services, how long it takes you to provide goods and services, how long it takes you to get back that cash, and how long it takes you to pay your vendors. So let me use another example. You want to set up, let me not talk about regular day-to-day business. You want to set up a new tour. That tour requires safety equipment. You order the safety equipment from China. It takes you, so you don't have any credit with this vendor in China. You immediately pay out, let's say $100 to this vendor in China. That's instant, one day. The vendor in China already has stock of this safety equipment, and it takes them 3 months to ship the safety equipment to you because of our current logistics challenges, right? So you finally get the safety equipment. So 91 days has passed from 1 day to send the payment, 90 days to get your safety equipment back. So we've got 91 days, right? You now have your safety equipment in place and you start booking tours. So you may have been running some online ads, etc., and say this is now the 20th of the month, you just got your safety equipment. This is perfect because you have your first tour about to be operated on the 28th of the month. So it takes you 8 days more wait before you can provide that goods or services to the client. Thankfully, it's just a 1-day tour, bam, one time. So we've gone 1 day here, 90 days back over for us to provide the capacity, 8 days for us to provide the goods and services. So we've got 99 days. The customer paid you via your credit card machine on the day in the morning. So you've been paid, thank God, right? But the bank takes 2 days to settle that money back to your account. So we've gone 1 day plus 90, 91, plus 8 days, 99, plus 2 days, 101 days. And so your turnover cycle is 101 days from the point that you invested that money to it coming back in revenue. And you still haven't fully paid off for that safety equipment yet. This is just day one of tours. But this is the full cycle that it took you from spending $1 here to getting it back into the business over there. It sounds alarming, right? But I'm pretty sure that many of you have seen a similar conversion cycle in your own business. So when you decided that you needed to invest $100 US into improving your business, you really and truly, you invested $100 US, but you don't see the growth for another 101 days before that starts contributing to your revenue. And let me not even get into profits, cash flow, anything else from there. We're just talking about general revenue, right? So this is why you have to understand the cash conversion cycle and exactly how spending money, how long does it take to get back that dollar? Now on the inverse, let's talk about your day-to-day operations. Let's say that you wanted to offer drinks, just regular water as part of your tour, right? You could, if the tour date is the 28th, you could have spent money on the 27th to go to your supplier, the supermarket, the wholesale, they call for a delivery. You spend some money on the 27th. You get the goods on the 27th. You sell this bottle of water for $150 on the 28th, and immediately, they paid for it with a credit card, so you still have to wait 2 days for settlement, and you get it back. So you spent money, let's come back to say $100. You spent $100 on the 27th. It comes back into your account by the 29th. And so the cash conversion cycle for that is only 2 days. And so when you talk about a cash conversion cycle in your business, typically you work with an average cash conversion cycle days, because $1 might take 101 days to come in, but another dollar might only take 2 days to come back. And depending on the volume of transactions in either case, then it will reduce the average of your cash conversion cycle. But you really and truly do have to understand your business operations on a day-to-day basis to understand when you spend certain money, how long it takes to come back versus others. And so you can prioritize who gets paid at what time because of the impact on your cash cycle. This is a heavy concept. I don't expect everybody to understand this. It takes a while to get comfortable and used to this process. This is something that typically not even an accountant, but a finance manager would manage in your business and monitor and make sure that these things are optimized. But you yourself, if you're aware of this, you can ask your accountant to do these calculations with the reports on a weekly, monthly, quarterly basis, and pay attention to the cycle because it can increase your profits. Once again, an example of how you spent $100 on safety equipment, and yes, it's required to go through, but it took 101 days, and the payoff for the safety equipment is going to take, let's just say, a year. Versus if you sell a bottle of water, it only takes 3 days and it generates 50% profit immediately. You don't have to wait a year, it's only 3 days and you have a high profit margin. So therefore, investing more in selling drinks or refreshments to your tour participants could yield much more profit than actually selling the tour because of how long it takes to build, to regenerate a dollar from investing in the tour itself, right? You can just have a lot more profit margin in that case. And so that is why, let me use an example. Gas stations make, I think, 5 times more money from their convenience stores than they do from the sale of gas, because the cash conversion cycle is much faster and more lucrative than the actual sale of gas. Where people come to a gas station to top up, everybody needs it, but it's that extra, oh, I need a snack, I need to buy some wiper blades, I need a drink sort of thing. That makes the gas station way more money. And I'm pretty sure a couple of you would have also noticed that you make more money from some accessory services or add-on services than maybe the core business operation as well. Coming back to strengths and opportunities in your business, if you have a strong cash conversion cycle, that's a strength. But if you identify an opportunity that, hey, we can add this on and make a lot more money in a short period of time, that's an opportunity and a great thing to share with your financier to say, this is why we want funding, because we think that we can increase our revenue by 10 or 20% by investing in this one area. I hope everybody's following. Once again, reminder, if it's too intense, if you have some detailed questions, just ask in the Q&A. And we would be happy to help. Remember, you'll also get a copy of the slides, the recording, and the guide, which is in more detail after this session. So, should I start with this? The simple calculation for a cycle length is the total days it takes to sell and satisfy agreement, plus the days it takes to get paid, minus the days until your payment suppliers are due. So if it takes you 8 days to sell, plus the days it takes to get paid, so your bank settles that credit card transaction 2 days, that's 10 days, minus the days until the dates the suppliers are due. Let's just say we're dealing with JPS and or another utility, your electricity, your internet, etc. Maybe you got paid on the 28th, but the payment due date for your utilities is not until the 5th of the month. So that would be 8 days plus 2 days, that's 10 days, minus 5. That would be a 5-day cash conversion cycle if you're to compare it to your utilities, right? And you just sit down with your bills as an example, just use one bill, and then you can begin to understand. There's another thing called average payables days. Your accountant should be familiar with that as far as how many days before you have to pay your vendors. It's basically related to the credit terms. You could use that as well for your calculation. Just expect to work very much with your accountant during this process. They're going to help to calculate some of these things for you and to help support you in understanding some of these concepts. As I mentioned before, the cash flow trough, right? So here's the thing. Let's come back to the example of the safety equipment for your tour. You ordered in, this is what, 6-month cycles? Okay, so let's just say, this is an old chart, but say in September 2011, you ordered that safety equipment, right? You had to spend money, and it's not just the safety equipment, you're setting up a new tour. So you, safety equipment, you hired new staff, you had to pay for training, you had to pay for advertising, et cetera, because you want to launch the tour in October, right? So follow this blue line with me now. This is your total cash being spent. So September 2011, you say, listen, we want to launch a new tour in October, and this is how we're going to get it done. So you invest in your safety equipment team, et cetera. You launch the tour a year later in October 2012. You still have some additional expenses to come in, etc. This would have brought you down. In total, you invested 200,000, in this case, euros, or just a little over 200,000 euros over a 1.5-year period in this new tour or in this new venture that you're offering. In that same time, you weren't making any money off of it. So at the point of right here, that would be around December, the revenues start to increase, and suddenly, instead of you're spending a lot of cash, you start generating positive cash flows on a daily, monthly basis. So this is this red line is your cash flow from operations. This is your existing business revenue, cash flow before. It's negative because you start spending a bunch of cash, but your new tour is up and running, you're making more money, and now you have a cash flow positive from operations on a day-to-day basis. This green line is what we're talking about from financing. This initial amount would have been the investment about you're seeking for. So if you had worked out your cash flow trough before, you understand that this line here, the investment space here, you'd have been 200,000+ euros down. So up front, you ask for 200,000+ euros so that way at no point do you fall below a negative balance in your bank account. And so when the revenues do come in and your cash flow positive, you start generating more and more cash. You're up to 400,000, right? You might say, whoa, Dimitri, 400,000, that's great. Just remember that part of that has to go back to the financier for investment as well. So make your monthly payments. You might have a lump sum payment. You might have to pay dividends, whatever way, but you are now generating more cash because you recuperated by this sort of in 2014. So you started in 2011 with implementation. 2014, you recuperated the money, and now you have the 200,000 invested plus more because the initiative was successful. All right. So guys, this is why I reemphasize over and over. You have to understand the cash flow trough because it tells you how much investment you need. You prepare for that by asking for the investment up front. So you have those funds prepared, and so you don't fall below zero. And the zero line is a theoretical line. It's really and truly whatever your minimum buffer is. Remember, things can happen. I mean, we're all faced that with the recent pandemic. You might want a buffer, maybe it is 100,000, how much ever 3 months, 6 months, a year of your business expenses. You don't go below that minimum buffer going forward. All right. I figure we might get some questions here. Let me pause a minute just in case. And while I wait on the questions, remember, blue line is your expenses. Red line is the cash flow from your operating activities, just how much you're selling on a month-to-month basis. And green line is basically how much money you asked for up front and how much you're returning from the business because of the investment amount. So the yellow line here is the full trough from 0 to negative 200 and let's call that 210,000. And because you realize you're going to go negative, you seek investment. It doesn't have to be one single investment. It could be multiple or different types upfront, so you don't fall below your buffer or your minimum. All right, I think that was a minute. Maria, no additional questions so far?
No, I asked. No one has any
Okay,
questions.
guys. All right. And remember to use the Q&A, guys. We're not monitoring the chat. So if you have questions related to it, use the Q&A. So coming into the different types of expenses, what is capital expenditure? I mentioned it earlier. It's funds used by a company to acquire, upgrade, and maintain physical assets such as property, plants, buildings, technology, or equipment. So if it's a physical item that you hold, then that's typically a CapEx. So you need to buy a new vehicle to operate a tour. That's a capital expenditure. You need to make improvement to the facilities that you have. You need to buy safety equipment. You need to buy a new point of sale machine, things like that. That's capital expenditure. Other things such as you need to build a new website, you need to build an app, things like that, that is a capital expenditure overall. What's operating expenditure? It's an expense that a business incurs through normal operations, abbreviated as OPEX. It includes rent, equipment, inventory costs, marketing, payroll, insurance, step costs, funds for research and development, etc. So you want to launch a new product or service and you do market research, that's operating expenditure. The salaries that you pay for your team members and yourself, that's operating expenditure. The rent for your facility is OPEX. If you have in the case of like your website, such as the paying for your domain name, paying for the monthly subscriptions to keep it going, that's operating expenditure. Typically your marketing costs would be operating expenditure. What else? Insurance, etc., etc. So CapEx is stuff that you buy physically and will hold, and you normally write stuff over a period of time. OPEX is stuff that you're paying for on a periodic basis, monthly, quarterly, annually, and you know, it's typically not a physical asset. All right. Some equipment may be operating expenditure, right? But there's a gray line, and your accountant would advise you whether that equipment is CapEx or OPEX. So for instance, oftentimes like a cell phone, I don't typically categorized as CapEx, even though some people do. But because cell phones change, you know, every year, 2 years, or it may not have a long life, you may want to just expense it as an operating expense going forward. What else? Going forward, you have to research your financing options. You have microfinancing, you have commercial debt, you have types of alternative financing like mezzanine financing or receivables financing. There's private equity, there's public equity, there's venture capital. Unfortunately, we can't go through all of these today. Most people here will be looking at commercial debt, microfinancing, and maybe some private equity in the near future. Quick examples, microfinancing would be short-term loans. Typically, you're going to get at small values, high interest rates, probably the easiest form of financing to get. Commercial debt would be your longer term loans, typically, you know, 3 years or more, sometimes secured by a physical asset or unsecured. And then you have your private equity. This would be an investor that comes in and buys shares in your company. Well, invest money in your company in exchange for shares. Public equity is similar. If you guys have heard about IPOs and the listing process, that would be public equity. And venture capital is a form of private equity that is just more risk-based. Here are some use cases of how to use different financing applications. So you'd use microfinancing maybe for short-term CapEx. Let's just say that you had a low-cost asset that has failed in your business, a stove. Maybe it is that, you know, you need some new technology, some other stuff that you can pay for quickly because it's relatively low cost. You can use it for short-term CapEx. You can use it for short-term OpEx. Short-term OpEx would be maybe a short on salaries this month because you have to pay everything on the 25th, but you're not getting the money back to the 28th. You know, take out a short-term microfinancing loan for that. You don't want to use it for long-term CapEx because it's very expensive, high interest rates. You don't want to use it for long-term OpEx because high interest rates. It is not low risk because it has a high interest rate. And yeah, commercial debt unsecured. You can use it for short-term OpEx, short-term CapEx. Usually not so much for long-term CapEx, maybe long-term OpEx. Why I say maybe for that, let's just say that you have a line of credit with a bank. And so you use that as your buffer. You just know that you always have a couple $1 million available to you. You don't plan to ever really pay it back. You just have this cash on hand in case you need it. So great use case there. It is not low risk because it's typically a higher interest rate. When you have commercial debt secured, you wouldn't use this for short-term CapEx because it's a longer loan period, typically 3 or more years. You may use it for short-term OpEx. Let's say you're asset rich, you own the land that you operate on or something, and you want to borrow some money. You can leverage or secure the loan based on that land, and you get a loan at a cheaper rate. You can use it for long-term CapEx. You may not want to use it for long-term OpEx, and it's pretty low risk. Mezzanine financing is a maybe all around. It's a little complicated for most people. Private equity, great for long-term CapEx and OpEx, not a short-term thing. Venture capital is also not a short-term thing, so that would be long-term CapEx, OpEx, and it is also high risk. And public equity is definitely not short-term. You're in the public sphere. This is the IPO process. Other members of the public buy shares. You have to produce quarterly reports, etc. And that's for long-term CapEx or OpEx goals overall. That's a ton of information. I'd really be surprised if you guys have a question now, but feel free to ask and I'll touch on that. In the meantime, while evaluating or thinking of a question, you want to make sure that you find the right financier. It's not just anybody that's willing to offer you money. You should research deals that they've completed in your industry. Look for negative outcomes of deals, bad press, etc. Ask your peers if they've had a bad experience with that financier. Use your network, find finance contacts that can be referred. So if you have other companies in your industry that have gotten financing before, ask them where they got financing from, etc., because you want trust and familiarity. take a look at their website, look at their strategy, check their annual report, understand your financier better, because it's a long-term relationship and you want to know how it is that they make money, how it is that they deal with their customers, things like that. And reach out professionally. I mean, you are not begging money any at all. This is a business transaction. And so it's important that you yourself are professional in your conduct and manner with the financier, but they in the same way should be professional and responsible in their responses, in their timeliness, other things. If they're not acting professionally, move along. This is a cultural challenge within that organization, and you may not want to work with them because it's going to cause you problems later on. Some of the documentation required for financing typically is your, once again, company overview and the growth strategy. It always starts with the growth strategy. The management team overview and CVs to demonstrate what your team structure is like and your capacity, your financial projections, historical financials are preferably audited. Auditing is a process where an external agency comes and double checks all of your accounting to make sure that, you know, it's not fraudulent, and to verify from a third party that the numbers are correct. You need to know the category or blend of financing required. As we highlighted before with that cash flow trough, that was 200,000 euros, but you may not have needed all of that from one type of financing. Maybe you need some, you know, $20,000 from microfinancing, then another 100,000 from some unsecured debt, maybe another $100,000 from secured financing, and maybe you got a little bit in equity as well because you didn't want to leverage yourself too much with debt, and so you got some equity financing as well, right? Use of funds, how is that you're going to spend this money that's coming in, the financing cash, your compliance records such as your TCC and other things to make sure that you're tax compliant and in accordance with any regulators. I mean, this for TPDCO, other regulatory agencies that you're working with. And then finally, governance documents, your articles of incorporation, shareholder agreements, who are the directors of the company, et cetera, because once again, governance is a critical part of the financing process. The debt funding process, this is typically how it works. You internally, over the period of a month, you decide on what product you'd like to pursue. You collect the required documentation from the financial institution. You then reach out to the bank, typically a loan processor. This will take about 2 days. You submit the collated documentation and complete the application. I have this as 2 days. And guys, most people say, no, Dimitri, you know, you're chatting crap. It takes us months to get through with our loan officer. If you collected the required documentation properly in your internal process, then it should only take 2 days with your loan officer. So preparation is key, right? The bank then has something called an adjudicator. This is the person that looks through all the information submitted and determines the credit worthiness of the institution and if you qualify for the product that you selected. So this is a lending decision process. It may require additional documentation. So say the adjudicator says, okay, we like all of this information, but we think that there's some additional risks. Can you submit us this additional documentation so we can understand those risks? That's why banks will come back and say, oh, we need more documentation. We need more documentation. Most times the loan officer is really bad at communicating this properly. But if you understand the process, then you'll be better prepared for that. So the loan officer may just send you an email. We need you to send us 5 years worth of projections instead of 3, or we need you to give us more historical accounts, but they don't tell you why. The key question is always to ask why, so that way when you're preparing the additional documentation, you can focus on satisfying that question or what's that they're trying to find out. The loan officer is basically a glorified salesperson, and they do not understand your business or what the adjudicator wants. It sucks. It's a broken system, I know, but if you understand, then you'll be able to overcome and get through this process faster. So afterwards, they'll share the lending terms, basically the approval, the lending terms being the interest rate, what the repayment period is like, etc. Don't just take that at face value, negotiate. Maybe you might have applied to multiple banks. You can feel free to just say, hey, this other bank is offering me a 2% cheaper, what can you do? Or this other bank has eliminated the loan processing fees, what can you do? Or just upfront tell them, hey, I don't have that as an affordable option. I can't afford 8%, I can afford 7%. And it's going to make it a lot more feasible. And they will look back at your financials and say, you know, it's true. If we offer it at 7%, they're more likely to repay this entire loan. Whereas if we lend them at 8%, then we may have issues collecting this money in the future. Remember, back to the philosophy, banks are in the business of protecting their money, of protecting capital. And so that's why this process sucks so much, because they really and truly want to make sure that when they lend out this money, they're going to get it back, because they have to make so much more money on other lending for every loan that is defaulted. When you've weighed the cost of financing and determined that it's feasible, then you can accept, and then you spend the money on your growth initiatives as part of that growth strategy that you highlighted and shared with the bank in the first place. And that is it, guys. I'm pretty sure you must have questions by now. So let's jump into Q&A.
Yes.
Right. So we do have one. Oh, who is speaking? Am I interrupting someone?
Go ahead, Marriott. I was just going to, the same
Oh.
question was posed in the chat, so I was going to repeat, but go ahead.
Okay, so I am building a villa in Lawrence Tavern. I don't have a lot of capital. However, I purchased the land already and did the topography survey and reached the basic architectural stage. How much of the business should I give up for capital? I'm thinking 35%. What's your advice?
Well, that's very hard to answer. And I'm assuming you're giving up 35% because you're getting a private equity investor or an equity-based investor overall. So it depends on what you need and what the growth prospect looks like. What the building itself as a villa, are you operating the villa yourself? Is it part of, I don't know, are you going to list it on Airbnb? Are you part of a larger chain? I don't understand the growth strategy that you have. So therefore I can't say that 35% is a good or a bad deal. I also don't know how much existing cash flow you have. So I don't have the details to answer the question, but the key is if you purchase the land and you're building a villa and you plan to, if you have existing cash flow, whether through other income, and I assume you have other income which allowed you to purchase the land and start construction and starting survey, I would get a development loan from a bank to complete the construction phase. And oftentimes, I mean, banks do have financing options for villa hotel operators. Even if you're just listing on Airbnb, they understand that very well now and would be willing to give you an investment loan. Typically, way cheaper than 35%, it would be about 8 or 9% per year, where you can complete the building. They will defer payments until construction is complete, and then you make either periodic payments per month or on a quarterly basis for those payments going forward. That would not require giving up equity. Now, if you don't qualify for that loan, you may need an equity partner, but I would say, you know, just get just enough equity to fill that gap, so that way you can get to operations, like start operations for that villa.
Can I also just add something, Dimitri, to say
Sure.
that the villa, that they're going to be operating in the tourism industry, so they may well qualify for the tourism incentive as well. So my suggestion would be also to contact the Ministry of Tourism.
Definitely. There are actually quite a few incentives with regards to the import of materials for the tourism industry, where you can get significant discounts for the importation of equipment, material, other things for that property. So definitely register with TPDCO, work with the ministry, and get your import exemption form, so that way the finishings and other things you can import at a reduced tax rate overall, or even for the GCT charge for some services, you can get charged at a lower tax rate as well. Jennifer's asking to tell more about the tourism incentive. Coral, you want to take that one?
I don't know why my unmute button won't work. I don't really have, as you explained, it's an incentive where they get a tax break on bringing in equipment and material and stuff like that, that's going to be used in the tourism industry. It also covers things after you start operating. So I know it covers things like, you know, you're bringing in linen or anything that goes towards the operation of that facility. But I can send out, when we send the information later after the session, I can send a contact from the Ministry of Tourism, the person who's responsible for the tourism incentive program. So I can include that in the information that's sent out to everyone so that they can reach out to the Ministry of Tourism for more information.
Yeah, and I don't have it in front of me now, but if you search tourism omnibus tax incentive, it should pop up on Google as well. I think PwC did a great summary of the incentives a couple of years back, and normally they're on the first page. Also, if you see any links from JAMPRO, they also have an outline on their website, but tourism omnibus tax incentive.
Yeah.
Okay. Any other questions, guys? Once again, please make use of the time.
Well, sorry, Dimitri. Rebecca has just posted the link in chat for the tourism incentive. I think the PwC has posted something on tax credits and incentives. So Rebecca has just posted the link in chat.
Yeah, I really like the PwC tax summaries. It makes it very easy for anybody to understand. Of course, if you want to leverage them, they can also advise you on how to use them, but it's just great general information for people to know and understand what incentives exist, and then you can reach out directly to whichever ministry, agency, or even with your own accountant to benefit from the incentives. You don't have to go through PwC. You can, I found one of the greatest resources available to small business, well, any business operating in Jamaica is actually TAJ's hotline, 1-888 tax help. You can just call them and they're very knowledgeable and give a lot of information. And as Arlene just shared in the chat as well, JAMPRO will also assist. If you call them, they will give you a breakdown of the benefits, but it's also on their website. Okay, anything else for Q&A? I know it was a lot, guys. Lots to absorb. I hope you got some good notes along the way as well. And remember, guys, we will be sharing the slides and the guide after this for your reference material. I mean, the guide is way more in-depth. It carries you step-by-step how to prepare for the process. I once again implore you to just take an hour, take it section by section. Do not read everything one time. It is going to overwhelm you, but just one page at a time, move forward, complete the steps. It's a very manageable process, and I think many of you will benefit from utilizing the guide. Are there any known grants for businesses in the startup stage? Okay, so there are a few. We've actually listed a few resources in the guide as well that you will be able to access, but I do know that DBJ has their Ignite program, should be opening up for applications again shortly if they haven't already. They provide grants for startup, but you would have already had to be registered. So don't just, basically whenever you are operating a business or want to start a business, make sure to register first and be formalized, because very few grants and financing opportunities exist for unregistered businesses. And because of the nature of the types of financing, they typically don't like it when businesses were registered in the month or less than 6 months than when the opportunity came out. And the other question is it always best to go through a financier when starting a business? I am not sure well, it depends on your financing needs. So the first thing comes back down to a cash flow trap. If you have enough money to invest capital in the business and you have enough cash flow, you may not need to go through a financier at all. So depending on your growth strategy, that will determine how much financing you need, and then depending on the expenses, that will determine the type of financing you need to meet those expenses. So what I'll say it's always best to do is to work with an attorney and an accountant to understand your business and understand your growth strategy before speaking with a financier.
Great. Thank you. Thank you so much, Dimitri. Is this, are there any other questions? If you can stop sharing.
Sure.
I will just share another slide. Great, thanks everyone. Thank you so much for your patience, and thanks for joining again. Dimitri, I think that was very interesting, and I'm really hoping that everyone will be able to take away some of this information and use it in their businesses positively. As I said before, we'll share the manual. We'll also share the slides, copies of the slides for this presentation, as well as the recording from this session. As with the previous session, you know, we will send you all the information that we've just mentioned before, and we'll also be sharing with you the contact information from the Ministry of Tourism that I mentioned earlier for regarding the tourism incentive. Join us again, please, next week on Thursday, the 27th, for the session on future-proofing your business. In that session, you'll learn how to make your business strong and sustainable through energy and through resource efficiency, while also benefiting your local community. So we're really looking forward to seeing you again next week. But before you log off, we're going to just ask you for 1 more minute of your time, as we're going to launch a short poll. Rebecca, are you able to launch the poll? Perfect. The poll should be on your screens right now. Just 1 more minute of your time to just give your feedback, as your feedback is going to be very helpful for us in planning future webinars. So just take a minute for us, please. Fill out that poll and submit it. Once you've submitted it, you're free to exit the webinar. I want to thank you all again for being with us. Thank you for joining us for these last few weeks, and we're looking forward to seeing you next week and the following week for the next webinars.